Hello, everybody. Mike Sorrentino here, along with Bepin, and thank you for taking the time to listen to our Thanksgiving edition of Market Pulse. We'll call it that. The folly of forecasting. Always a fun subject. I think it's a timely one. I feel like at the end of every year, Bepin, this is the time of the year where we start seeing all the forecasts for the upcoming year coming out. Right? What's the S&P 500 going to do? What's GDP going to do? What are earnings going to do? It all kind of starts now to the end of the year.
Yep.
So, what we wanted to do today was talk a little bit about different types of forecasts, the way we view forecasting here. Okay, not just our own, but rather how we digest and listen to what Wall Street and all the other fancy banks are telling us, and then how we actually inform those in our own investment decisions. But before we get started, let's level the playing field and make sure that we are all grounded before we start trying to predict the future. From Warren Buffett, forecasts usually tell us more about the forecaster than of the future. That is a very, very telling forecast. Remember one thing about people on Wall Street: they are very smart, they're very educated, they're very driven, but they're also oftentimes very, very much self interested. In fact, what we did was we decided to go back and see if we could ascertain any other additional information from forecasting than just to see if they were right or wrong. So what we did is we went back to the year 2000. So follow me on this chart because this chart's going to tell us a lot. For every single year from 2000 to the end of last year, or 2023 rather, excuse me, we basically did a very simple test or a simple estimation. All right. So we went into our very fancy Bloomberg terminal here, and we said, for each year, give me the average forecast of the top 12 Wall Street strategists out there. Okay. So basically, what happens. So in this example, let's use the far left-hand side, the year 2000. That small little blue bar there represents the average forecast of the top 12 Wall Street strategists at these big banks like Goldman Sachs, Morgan Stanley, Citibank, all of them. Okay. Now, let's very, very clear about something. These are extremely smart, well informed blue bars, every single one of them. Think about all of the research, the money, the time that goes into trying to figure out what these forecasts are. These are not dumb people. These Wall Street strategists, they get paid millions of dollars a year. I personally know two of them, one I'm close friends with. He's done very, very well. Okay. But he has also worked so many hours, he doesn't remember his kids' names anymore. They sleep in their offices. I'm telling you that this is a very, very smart group of people putting these numbers together. And they have unlimited budgets. They can spend money any which way they want to get that forecast right. So, what we've done here is we've created an average forecast. That blue bar is at the beginning of every year going back to the year 2000. Now, let's compare to what actually happened at the end of the year with the purple bars. Okay, so the purple bars you see here are what happened at the end of every year. Bepin, please tell me you see a trend here because I certainly do.
Yeah, a lot of wrong estimates, and no
They're
one ever
terrible.
predicts. No one ever predicts a drawdown.
Yeah, Bepin, you're being a lot nicer than I am. I think they're terrible. I mean, look at the left-hand side of this chart. They're in the exact opposite directions. And if you're having a hard time squinting on the screen because you can't find 2008, just look for the largest purple bar. What is going on here? These are not, like I said, they're not dumb people. It's not like they don't possess the education or the backgrounds to do this stuff. What's happening here, to be blunt, is that they are being tasked and paid to do the impossible. The impossible. If you ask me, what do I think Apple's earnings are going to look like 2, 3 years down the line? Well, I also have another fancy Excel spreadsheet on my computer, and I could probably figure that out. Now, am I going to be exactly accurate? No, but I'm going to be pretty darn close. And that's where the kind of the rigor and the expertise comes from this job. All right, because over the long run, stocks are fueled on earnings, revenue, cash flow, competitive positioning, good management teams, all those things that we can quantify into a forecast. But if you ask me what drives markets over the short term, all right, next 3 months, 6 months, or a year and a half, there's only four things. Only four things, Bepin. You already know what they are. They're fear, panic, greed, and euphoria. All right, there's technically a fifth one. I'm going to get yelled at from compliance for saying this. Stupidity. All
Yeah.
right. All of those human emotions that wreak havoc in every facet of our life, investing is no different. No different. So basically, what they're being tasked to do is to go out and say, okay, what do I think the emotional component of the market is going to be over the next 12 months? So, Bepin, I've got two young daughters, 6 and 8 years old, happiest, cutest girls in the world. They're the best friends. And I'm telling you, that when out of nowhere, completely out of nowhere, they want to just tear each other apart. They get in these crazy fights, but you know what? They don't last very long. They don't last long. They last for a couple minutes and it goes away. All right. So I'm around these kids all the time, completely unpredictable. I never know when it's going to happen, but I know that it resolves itself very quickly. So I don't freak out about it. So what I don't want to do as an investor, what I don't want to do is I don't want to take these forecasts too seriously because I know they're going to be very, very wrong. Because you cannot estimate. There's no Excel spreadsheet on the planet that can forecast human behavior. So, are these useless? Are these a waste of time? Should you just ignore the forecast? No, actually, I don't know about you, Pep, but I get a lot out of reading these forecasts. You want to know why? It's because I like the idea of listening to somebody else's opinion. All right. And
Mhm.
furthermore, if anybody out there has ever owned a business before, all right, one of the best things you could do at the beginning of the year is forecast what your revenues or expenses are going to be. Now, are they going to be right? No, they're never right. I've done this every year for the last 25 years of my life. They're never right. But it forces you to think about the drivers of your business. The same way here, it forces Bepin and myself to think about what could be driving returns and stock prices over the coming 12 months. That's where the is. Not the number per se, but the actual process of thinking through what could cause markets to go up or down. And here's the thing. What's interesting about the stock market, especially, is that the an average year. So if you think about there's this idea out there, all right, that we should have an expectation that the stock market is going to return 10% a year. Now, where did this come from? It's not just made up. I mean, there's a lot of legitimacy around that 10% number, depending upon the time frame. But if you go back, uh, 40, 50 years, depending on what you're looking at, the average is right around 8 to 10%. In this example here, we're going back to what 1950. So that 8 to 10% range is just an average of every year. But here's the thing about average, quote unquote averages. Averages get impacted by large distributions or large variances. Okay. So outliers, they tend to push averages in multiple directions. But I think more importantly here is that even though the average return is called 10%, on an annual basis, it is extremely rare to actually have a quote unquote average year. Most of the time, the returns are a lot higher than that 8 to 10% range or lower. So even though you could sit there and say, well, stocks average about 10% a year, and from a financial planning perspective, that's often used, and I don't think there's anything wrong with that. But you have to have an expectation that though, even though an average year might be 8 to 10%, you're probably not going to get that. In this chart going back to 1950, what do we have? Four times where the return of the S&P has fallen within that 8 to 10% range going back 75 years. Crazy. So what are we talking about here? Well, there's on the direction and not on the target. Okay. It's very simple. Well, does Citibank say 10, Morgan Stanley saying 20%, and all these different numbers being thrown out there? Again, we know those numbers are going to be wrong. All right. You're the lucky or you're wrong. That's the only way to forecast. But directionally, you got to pay attention to what the direction is telling us. Okay. And directionally, I think that's where a lot of the value comes out. All right. Now, there are a couple of ways we could do this. If you have 12 economists or 12 strategists in a room, and 11 are saying it's all going to be up and one's going to be really down, all right, you might want to pay attention to why that one person, why they're so negative. All right.
Yeah.
But at the same time, if you look at the forecast going into next year, as we see here, again, don't necessarily worry that Deutsche Bank is saying the S&P is going to hit 8,000. Don't worry that Morgan Stanley is saying 7,600, which is amazing considering how bearish he usually is. Um, Focus on the fact that we are seeing a, I don't want to say unanimous, but a very high concentration of optimism going into the next year. Okay. Now, there are two things that drive stock prices: earnings and valuation. Okay. Valuation would, think about a house. Okay. You got your house that might have kind of a price per square foot type of a metric. Well, in our world, Bep and I like to look at price to earnings ratios or PE ratios. All right. So when we think about going forward, there are the two components of a stock price. One is very difficult to predict, which is the valuation. We talked about that. That can be a measure of emotion to some degree a lot of times. But what is a lot easier to predict and a lot more reliable for that matter is earnings. It's never perfect. But if you remember that first chart we showed at the beginning about how bad the forecasts were of the S&P 500, what you see here is that the forecast for earnings tends to be way closer. Okay, so all those two components of the stock price, valuation, very, very difficult to guess. Okay, but forecasting earnings, as you can see here, these light grayish bars on the chart compared to the blue bar right next to it, that is a very, very tight spread between those two consistently across time. There's been a couple outliers here and there, but for all intents and purposes, it tends to be pretty close. So what Bepin and I try to do from our perspective is focus more on earnings because over the long run, the very long run, 3, 4, 5 years, earnings is the number one driver of stock price.
Exactly. And the chart you're looking at your screen is exactly the same chart I believe we went over in early January or late December of last year, highlighting this exact same phenomenon, which is ignore the forecast for the most part. Yes, there is some value to be gained from them, but really the place to really spend your time on and focus is on earnings estimates. And so we're looking here at the far right there. You'll see that gray shaded bar. That was for the calendar year 2025. At the beginning of the year, the expectations were at 275 per share of the S&P 500. Let's see how they are as of a week ago. That bar on your screen, that dark blue bar that just popped up, is showing the current estimations for year-end earnings per share for the S&P 500, and it is on track to do $271 per share. That is about a 1.5% difference from the beginning of the year. So like Mike said, this is a very tight correlation between estimates and future results. Like I said, there also has been some outliers. The biggest ones that you can probably see on your screen are going to be the 2020 and 2021. If you were to average those 2 years, so if you were to average the actual earnings in 2020 and then the pull forward of all that missed demand while everyone was stuck at home, what they spent in 2021, you probably have extremely tight bars between those 2 years as well. Point being is that this is a very accurate estimate of the future. And going forward for next year, the actual expectation as of right now is for about 308 per share, about a 14% growth rate from today to next year. So the market is expected to continue growing. And yes, it likely will be led by likely a lot of the winners that we saw this year with AI being front and center. But we do expect some sort of broadening going into next year. Switching gears here a little bit. Another huge headline outside of obviously the forecast for next year, and then obviously AI. With Mike's article from last week, Matt and Steve doing a podcast on it 2 weeks before, and then Matt even doing another article on it a few weeks before that. I think you know our opinion on the AI phenomenon by now. So we wanted to switch gears a little bit here and talk about another area that's been all over financial news, which is the discussion around this K-shaped economy. And you may have never heard about the K-shaped economy, but you've definitely heard the concept from Mike and I over the last year or so that we've been doing these. They've had different names. So when we were talking about soft versus hard data, that's really what you're looking at on your screen here, which is in the blue bar, which is the S&P 500 going on the left axis there. That's the index value. And then on the right axis there in the red line is the Michigan Consumer Sentiment Survey. As you can see, the S&P 500, as you've seen in your accounts, the S&P 500 has gone up, but consumers don't feel good about it. The majority of consumers have been basically since COVID. It's been very negative out there. One of the main reasons for that, I think it's pretty self-evident, is that there's concentration of who's holding the S&P 500. I remember Mike specifically bringing this up, I think maybe 6, 7 months ago, talking about the haves and the have-nots, essentially, where it's if you owned assets, you felt really good during this time. Your purchasing power has kept up with the inflation that we saw over in 2022 and 2023. If you don't own assets, you have not been having as good of a time. And there are, in these surveys from the Michigan Consumer Sentiment Survey, that is wide based. They send that out to a lot of people, and majority of people are average everyday Americans. And the average everyday American, for the most part, actually isn't quite invested. That's kind of how you're seeing this tale of two cities, or this tale of two groups here, where it's the asset owners versus the non-asset owners, and that's what we're really seeing in this economy play out. And this is something that we've talked about since the beginning of this year. I remember earlier in the year we discussed how the consumer is doing, and me and Mike came to the conclusion that we presented to you that some consumers, the bottom 40%, aren't doing very well, but the middle, and as well as especially the top, has been doing very well. And a lot of it's been driven by stock market gains. So what you're looking at your screen here is the breakdown of stock market ownership by income percentiles. That black bar that you see at the bottom is the top 1%. And they happen to own 40% of the stock market. The next 19% to get us to that full 20, the top 20% own 48% of the stock market. Combined, they own about, let's say, almost 90% of the market. And all they've seen for the last 3 years is just the straight green arrow up. And what tends to happen as people gain more wealth, so that 20% owns about $40 trillion worth of the $46 trillion stock market. As they see those values swell up, it typically gives them confidence to continue spending. Not just continue spending, in most cases, increase spending. And to many of you listening on this call, you would fall into this range. And from firsthand experience, I don't think we've had almost any clients call in this year telling us, "Hey, we'd like to lower our income," or we don't want to make these extra purchases. It's been an absolutely green light on spending. It's almost like it's going out of style the way some people are spending. So it's because primarily of this wealth effect. It's that they've seen their asset values swell up, whether it be their financial assets here in like the stock market, or another topic we've talked about in the past, which is the housing. A lot of the top 20% also own a lot of the real estate in America. And real estate, even though we've ran into this little period of a little lull in the real estate market, prices, when you compare them to the 2019 or pre-COVID era, are still substantially higher. So as they see their net worth increase, they typically take that as a green light to continue spending. And as you've heard from us numerous times, is that the largest component of GDP is consumer spending. And this group that owns 90% of the stock market also drives almost 2/3 of the spending in the US. And they're in phenomenal shape. We would expect that their spending would not only just continue, it likely will increase as the stock market gains hold. And going into next year, we would expect the spending to feed into economic data, which we would expect to feed into GDP, which we would expect to feed into earnings, which will get us to that number we saw earlier, that 308 per share in the S&P 500 by the end of the year. This phenomenon is still intact, though we're seeing more of kind of a bifurcated society where you see some people not feeling great about their economic prospects. The ones that drive the majority of spending and de facto drive the majority of GDP do feel great about their net worth, and as well as like their ability to spend. They will likely continue to keep spending, and they will likely to continue to keep earnings growing, which is something we've talked about all year. So this is just something that me and Mike keep an eye on when we're talking about what do we get out of looking at forecasts? Well, we got the general direction people expect the market to go to. Then we look at earnings. Where do they expect earnings? They expect them to increase. Well, what's going to drive that increase in earnings? This is where we come to a conclusion. which is that the haves have more than ever, and they're going to continue to keep spending. We're not here to talk about like the rights and wrongs of society. That's for philosophers and politicians. Our job is to find out the drivers of economic growth, and this will be the largest driver, and we expect that to continue. And with that, we'd like to thank you for tuning in. As Mike said, this is our Thanksgiving edition, so we hope you and your families have a very happy Thanksgiving. If you have any questions, any concerns, feel free to reach out. Have a good rest of your day. Thanks for tuning in.